Okay, folks, trading the market profiles. In my experience as a mentor and trader, and being online talking to other traders around the world, and even traders in real life, it's been my experience to observe that they are all too many times rushed to get into the action of entering trades with no real understanding of the current market environment, or what I refer to as a profile. Now, market profiling is a concept that classifies what type of trading environment the current market is currently trading within. This swings the odds of success when you apply the proper technical analysis to the present profile. The market profiles that I personally use and approach my technical analysis with is considered four basic categories, really. The consolidation range profile, the breakout, which would be a valid and or false profile, the trending profile, and the reversal profile. Now, the consolidation range profile really is something that I learned from Larry Williams, and he talked about the nature of how price moves within trading range to a trade of some kind, like it could break out into a trend. In other words, you go from range, expansion, range, expansion, consolidation again. Okay, this phenomenon takes place in any time frame. I don't care which one you look at, it's always there. Now, how you as a trader can make a considerable amount of money is based on using the higher time frames, using this profile. You want to be looking for the directional bias during this consolidation. There's going to be all kinds of tips and clues that smart money will leave for you to be able to participate in the swing that takes place going down in this example. Typically, when you see the market start trading like it does here, going down, that's when the novice or street money gets excited and they start jumping in on the move. It doesn't mean you can't make money in that phase of the market, but it's just simply you have to be aware that you are in a move that's already been underway for a period of time. And if this is daily candles, there could be a stale move basically going into basically another consolidation, as we see here. Now, during this consolidation, traders will be trying their hardest to try to figure out what's going to happen. And if we can understand that if this is a bearish market environment, which is really what I'm trying to illustrate with this crude example, we would be more inclined to look for shorts during the upper portion of the consolidation area. Also, while we're in this consolidation, since we have a bearish market environment, okay, the range profile that we would use would be to look for optimal trade entry short patterns near the high end of the upper range of this consolidation, or one would look for a turtle soup, which would be a false breakout pattern. Okay, so this consolidation range profile is very handy in terms of determining what you should be doing overall, even if it's in a trending market or a non-trending market. Markets will always go back into some sort of consolidation, even if it's in a strong trend. The breakout will more or less typically fall in line with the prevailing trade direction going into the consolidation. And now that's barring any reversal pattern or market profile that we'll talk about in another module, because it does have some characteristics that can't be explained in this module, because we're going to focus on everything but the reversal pattern, reversal profile rather. Now, when markets go from consolidation to swing or trend back into consolidation, during the consolidation, you want to be focusing on getting positioned with the next swing before it happens. You don't want to be chasing price. Once it starts to break out, that's when we can be wrong. I mean, I hate to say it that way, but it could be a wrong decision. And the way we take our low risk, high probability trades are trading in the opposite direction of our anticipated price move. In this environment, we would be looking for a price to move lower, so we would be selling into any kind of rally during the consolidation. Maybe even reaching up to this old consolidation low range, and maybe even looking at the high of the previous consolidation to the low of the consolidation that we're currently in, and then reaching up for an optimal trade entry to get in sync with the market trend or market flow and build a short position on market structure, selling swing highs and getting ourselves in sync with the overall flow of the downward pressure that would eventually materialize. Now, once price breaks out of that consolidation again, while price trades down, we would be seeing the bars expand. Okay, you probably heard me refer to it as range expansion. This means basically that we went from usually an average or small range to larger or much bigger ranges, and that's where there's a lot of pips to be made. As a professional trader, you want to be focusing on the time periods that present the quiet time, because that's when the consolidation is doing what? Accumulating the next move. There is no reason for you to be chasing the market. So a good procedure for you to adopt is whenever you see prices start running, just sit on your hands. Don't do anything. Don't chase it, because that's exactly what the street money is doing. They're chasing and running after price, and you don't want to be doing that. You should have already been in that move, and if you haven't been placed before the move ensues, you wait for the next one. Now, just as simple as it was to illustrate a bullish market environment and using consolidation range profile, when we have a trading range or consolidation, we want to be looking for the clues that indicate where price will move next. We do not chase it once it starts running. Once it breaks out and starts moving higher and goes into another consolidation, we want to be using the low range or support level of the current consolidation, looking for optimal trade entry buy signals, pulling from the low of the previous consolidation up to the high in the present consolidation, or looking for turtle soup buy patterns. In other words, looking for stops being rated on the low end, any kind of important swing low of some kind. If we see the market trade down to it and snap away, that would confirm the indication that we would look for higher prices. And again, just like the previous slide, we want to be looking for times when the candles or bars are small. They're not really large. And we want to be trading against the probable direction for the trade we want to be trading in. In other words, if we're looking for a bullish move, we want to be entering on down candles. Okay, we want to be getting in the trade when it's moving against our anticipated trade direction. Now, how do you profile a market? Well, on the left hand side here, we have what would be considered a standard downtrending or downswing in the market until it reaches a low of some kind and you have a reversal formation. We're not going to cover the reversal here because there's a little bit more to it, but assuming that the market does reverse there, trades up, okay, and then we'll have a retracement of some kind. Now the retracement can be in the form of a new consolidation or range, okay, or it could be an intermediate term reversal pattern. We don't know that until price gives us its clues, but based on higher time frame support and resistance levels, we would have a reasonable expectation to see these swings unfold based on simple higher time frame analysis. No indicators, just simply looking at the higher time frame support and resistance levels. Now when price goes into a retracement and then starts consolidating, okay, we can see clearly that we've made a probable intermediate or long-term low. Price has snapped back and retraced. Okay, so this could be positioning a longer term trend move higher. So we would be looking for buy signals, okay, for swing trades or long trades, long position trades, and only taking shorts over in the right hand side of this diagram. If we get to this profile in the market, we would only be looking for scalps or real short-term intraday short positions, and not looking to hold on to our long-term um, intraday targets on the downside, because it could be just a smaller retracement within a higher time frame bullish move. So in this diagram, we've illustrated what would be considered a trending market down, a reversal, and a consolidation, and a potential breakout um, profile that would be on the right hand side. Now, the right hand portion where it's ranging, this could be a prolonged period of time. It could be weeks while it stays within this range. It doesn't mean you can't make money. It just means that you need to be aware of where the key support and resistance levels are, and keeping your trades limited to targets within that range, and in not chasing price up out of new territory. In other words, if it trades above this high here, look for turtle soup or optimal trade entry shorts, because it could be very well a long, not a long, but a short unfolding once it breaks out falsely and sucks the traders in. And you've seen plenty of examples of that this year with my Pro Traders Club videos. But within this consolidation, if we see optimal trade entry buy signals, obviously that would be the case here. As an example, we could look for price to go up, and we really have to be considering taking at least 70%, in my opinion, 70% of our profits off at the previous high noted here, because I don't know if it's going to stay within that range. If it does, 30% remaining of the original position on the long, that would be a ideal candidate to hold on to in case we do get the breakout. But I'm not a fan of chasing price into new territory. I think it's going to have a strong tendency to try to at least pull back within the range, and you have to have that mindset as a trader, because there are environments where you can make a lot of money while it stays within a range, and you can still make money in a trending reversal and consolidation or breakout profile. It just means you have to have the right tools and approach to trading within that profile. So looking at a daily chart, weekly chart, monthly chart, 4-hour chart, you can get the general market tone where it's going higher or lower based on support and resistance, fractal lows that were taken out. Where's market structure? Is it bearish? You can even include the COT data that we've learned in other videos. If commercials are poised to expect a long-term low in the market, and public traders are wildly bullish, okay, that could be a factor as well for your profiling. But basically, you just want to have the understanding of what price could probably do in the next coming sessions. Conversely, just like we discussed a potential market profiling candidate, we have a uptrending market reaching a reversal and then a retracement into a consolidation. Now, that high made here could be a long-term high, or it could be an intermediate-term high. We don't know, but we have to base our trading on the key levels that are presented to us on the higher time frames, and noting where they are and basing our trading on that. We would only be looking for buy signals in the right side of the chart here, this crude diagram. Only for scalps and intraday short-term targets. We would not look for our extreme retracement levels, extension levels on our fibs for our targets. We would simply look for the previous highs to be retested, and not much beyond that. Again, just like the other slide, I would not be interested in buying brand new fresh highs. I would look for profit taking there, and maybe even some shorts. I believe this indicates a bearish tone in the marketplace if this was a daily and or 4-hour chart, and focusing more on the short sells than the buy signals. Now, where is your focus? Okay, When you prepare for trading, do you spend time with the higher time frames and determine which profile the market is presently trading within? You do not want to trade simply just for the sake of taking some action, but rather you want to be trading with the highest probability in your favor. It makes sense when the market is trending. We as traders use trend-oriented analysis. When the market is in a reversal profile, this same trend-oriented analysis would likely present lower odds. Keep the focus on the current environment and get your trading in sync, and you will find trading far more easier than trying to force your treasured techniques into impossibilities.